the first step in using and quantifying is understanding that it's not the easiest thing. It's not price movement. Those two are independent of each other. I can go through periods of time and show you stocks that the market absolutely hated and they continue to climb.
Hello, welcome to the Wiggin Sessions. I am Addison Wiggin. Today I have with me Chris Johnson. CJ, as he's known, is an equity and options analyst with nearly 3 decades of experience. He's a quant expert by trade, specializing in applying advanced mathematics to Wall Street's data-rich landscape. CJ is the founder and CIO of ETF Advisory Research Partners and is widely recognized for innovation work in behavioral valuation systems. Since 1998, he's been developing and interpreting data models with his proprietary database, now analyzing a remarkable 700,000 daily records. I'm going to ask you about that in a minute. Currently, Chris contributes to Monday Morning as a quant analysis specialist. Welcome, Chris. Let's start right there. I'm mostly a macro guy. I look at history and trends and try to interpret what those trends are, what direction those trends are going in. We could probably just start by your explanation of what a quant trader is.
You know what? Let's just call us math nerds. Let's make it short and cut to the chase, Addison. We quantify things. We look at numbers, and especially as the data gets more and more rich, which it has over the last 20 years, you find that more data basically becomes something that can have more power to forecast. They always say history may not repeat itself, but it sounds similar, or, there are all kinds of sayings like that. Well, data helps you uncover that. It's really hard to ignore the fact that whether it's the dot-com bubble, whether it's the housing crisis, all of these things, these big macro events that we follow, they're also represented very, very, very well by those little bits of data that are out there. So we can form a picture of what's going on simply by, looking at the data. I love this analogy and I use it often. If you think about an airplane pilot, and I once took, some lessons to start getting my pilot's license, you have something that is called flying by sight. When you look out of the windshield of the plane, the screen of the plane, if you will. As you advance, you get to the point where you fly by the data, or you fly by instrument is what they refer to it as. That's basically what a quant will do. They'll fly by instrument through the market. And it serves me well because a lot of the time when you try to look through the windshield of the market, it's really foggy and you might end up, flying into a mountain or something. The data actually helps to give me that artificial landscape and all of that I need to navigate the markets.
Tell me about the database that I mentioned in the beginning. How is it possible to analyze 700,000 daily records?
Well, it's getting easier and easier with AI right now, but I'm old school.
Yeah.
I'm, one of these guys, and that number's up to about 1.4 million now because of different derivations there that happen, different calculations on that data. It all comes down to as basic as it gets, if-then statements. You have a lot of Boolean operators that you put together and say, if this happens, then I want to see this. And it keeps going down the road. And over the years, those if-then statements have become much longer. Written algorithms that have gone through the database for years and years and years. My first probably being when I learned SQL back in 2003. So it's one of those tools that you can use. They say, again, for instance, the trend is your friend. You figure out a way to quantify it, then you figure out a way to write a program or an algorithm that can not only quantify the trade, but give you those companies that are matching your preset criteria. So that's how you go through millions and millions of records a day and basically come up with a list of 10, 15, 20 stocks that you want to look at and longer term perspective, perhaps buy or sell.
And you put that in perspective of like the banking crisis of 2023. We got hit pretty hard in March, and I've been covering it from a macro perspective, writing about it. I did, I think, 5 or 6 live webinars on the subject, but I was looking at mostly historical records of what happens when banks get over indebted. They don't pay attention to rising interest rates, which is really what happened. And also, we had an innovative explosion in cryptocurrency where a lot of the money that was being deposited in like Signature Bank and Silicon Valley Bank were crypto profits or money that was made by tech startups and in and out of crypto. We had an explosion in innovation in the monetary market. So I was like covering it from that perspective. When you apply a quant approach or your proprietary database, what does it reveal when an event like that comes about? Because that took a lot of people by surprise in a few short weeks.
That is a great question. When you're looking at the data, I always say that, fundamentally, I have to be aware of what's going on fundamentally. And when something like that happens, that crisis, that hits seemingly out of nowhere. And as you mentioned, there was a setup there. There was somebody who's watched that fundamental data so closely, could kind of sense that, things were getting a little wobbly, or maybe we've extended ourselves too far. From my perspective, it's the market's reaction that really starts to matter. I always say fundamentals more or less will help to confirm a price, right? They'll tell you whether it's a price earnings ratio, whether it's a debt to equity, whatever it may be. They'll tell you whether something makes sense. But the market's reaction, and especially as we've progressed over the last 20 years, I mean, you as well as I can remember, the early 2000s and what's happened in trading since then. It's now more about the market's reaction and the market's perception of an event or the fundamentals of a situation that I have become more aware of and I'm able to use to gain my edge. So taking it back to March of 2023, and as I replay that whole moment, and ironically, I was skiing I was in Colorado when, the proverbial stuff really hit the fan there. And you had the KRE, the regional bank, just index really just collapse, or that ETF collapsed. But I had already been able to sense from the daily price activity and the volatility that was starting to get in there, as well as, again, the beginning of the market's reaction, which was you saw a flurry of put activity that was trading on these regional banks when there was nothing else happening outside of that small universe. When you put those two together for someone like myself, who's looking at the data at a micro level, that's when you go out and say, when I go out and say, what's the fundamental story right now? And you see a few of these headlines and you say, okay, the banks are now reacting to fear in the market. And that fear is typically something that will just absolutely unhinge a sector of the market itself. And I wasn't able to catch the top. I mean, it's pretty hard to catch a top or a bottom in a market. But just watching that daily activity in the price and investors' reaction in the price activity on those regional banks, and then that options activity was key when you saw a lot of people coming in and starting to hedge themselves for the next 2, 3, 4, even 6 months out. It kind of gave me that picture of, okay, this is a situation where I was already, they say luck prefers a prepared trader. I was actually already short the KRE with some puts. But that little step down is what really accelerated that move. And from my perspective, the quant view of that gives me something that I can now attach to the fundamental, where you've got a far better vision of what's going on there. I don't like to be driven by headlines so much. I like to be aware of them. Does that make sense?
Yeah. So you were short the QRE already. What prompted you to put that trade on?
It was all technicals. At that point, it was all technicals. The KRE was lagging the rest of the market weeks ahead. Regional banks, we were coming into the earnings season. And again, it was a little bit of luck preferring the prepared trader. But the regional banks, I had a relatively bearish, actually a very bearish outlook as we were heading into that earnings season, because I just seen the IWM, the small cap, which is that risk on, risk off index, had started to actually lead the market lower a little bit. Banks, regional banks especially, are a big part of that Russell 2000 index, along with retail. They were just at that point had come off a technically extended where they'd been overbought and were starting to go in a corrective phase. You know, they say the trend is your friend. I use the 50-day moving average to quantify the trend. And in that case, you already had a number of the banks that were breaking down below their 50-day moving average. That's a classic. It's time to get a little bit of hedge or short on this sector.
I want to dig into your background a little bit. When we were talking prior to beginning this recording, you had mentioned you worked with Bernie Schaefer for a while. I have known Bernie for a long time. We had a similar product to his. We're trading options as far back as the mid 90s. And Bernie had been already established there. And so just from a professional level, we knew him for a long time. And I think I visited the offices there in the early 2000s when you were actually there.
Yep.
We discovered that just by having a conversation.
That's right. Small circles, right?
Yeah. Explaining to me what the benefit of working with Bernie was for a number of years, like what it helped clarify your approach to the markets. And I'm just curious to have you explain that again, because I don't think I got it the first time.
So I came to work with Bernie and understand the environment I came from before. I was a licensed broker. I worked at Prudential Securities. Then I went from there to a regional bank here it's the old Star Bank, which turned into US Bank. Worked with the trust department there in the same capacity, doing research. And then I had a experience in options trading, which was something that's hard to find. And believe it or not, I actually replied to an ad in the Cincinnati Enquirer, a help wanted ad. Didn't know who it was, but it actually said, stated options experience a plus. And I kind of did that moment where it was, who in the world in Cincinnati would be trading options? It turned out that was the outfit, Schaefer's Investment Research. Those were my formative years in quantifying data, because I'd gone from a broker where you just turned on literally the squawk box and listened to Ralph Ekampora, Larry Wachtel, all these names tell you this is the stock that's best to buy for your clients, to immersing myself in research at the bank, and then immersing myself in a data-rich, technically based research background with Bernie. Man, I feel fortunate to have worked with Bernie for so long. And I'm not trying to give him the little, pump here, but it really was that cutting of my teeth that got me into the data side and analyzing the options market and understanding a couple of different things that I didn't. And that is that the group think on Wall Street doesn't work. It's exactly that. It's everybody chasing the same group of stocks until it doesn't work. And when you ignore the group and use sentiment and try to find those trades that are good trades, or those companies that are great companies that are, have fallen out of favor of the rest of the market, you can get ahead and gain an edge. So I've got him to thank for the incorporating of sentiment with my technicals. And the fundamentals, I already had a little bit of that, but it really kind of opened my eyes to everything else that's out there. And now the capacity that the derivatives market has grown. When I think about it, I can't remember the exact number, Addison, but in 1997, 1998, maybe 450 companies trading options, optionable companies on 4 different exchanges. To now 2,800 companies. The derivative market has exploded, as we all know. Volume grows every year. And having an inside track on actually analyzing that from a point of trying to figure out what the market is forecasting, the derivatives market is forecasting, and using that as that extra little missing link, that sentiment. Expectations, you mentioned behavioral valuation is what I refer to it as. Understanding the market's expectations are key in figuring out the behavior of a market, whether it's identifying a bubble, a bottom, whatever it is. And that's what I gained from working side by side with Bernie. And I think I mentioned to you yesterday, in the early days, There's the two of us on a Saturday morning, 6 feet from each other, pounding away at keyboards, going through data. So great edge in kind of narrowing my focus on the data side.
When I talk to quantitative analysts or even technical traders, people that are looking at moving averages and stuff like that, I often feel like there's a trap in logic, which is derived from what we call the curse of knowledge. Like you're so immersed in the data and in the mathematics of it. I thought I read that you had degrees in mathematics and finance. I mean, so it's a math-rich background that you were educated in too. I always feel like it's like from the perspective that I take into the markets, I mostly just read and write. I was decent in math when I was in school, but I didn't really like it that much, so I stopped. But how do you explain things like derivatives and options and the trend, or like how to play those trends that you see arising from the data on a simple level to people that, even though they're intelligent, it might be doing something else in their life that earns them enough money to want to learn how to manage it or whatever. You know, we talk to a lot of doctors and lawyers and dentists and stuff like that, people with enough money to worry about it. How do you explain your daily activities to them in a way that they can grasp?
You already said something there, the word simple. And, go back to that old acronym, KISS, keep it simple, stupid, right? I find that, first of all, writing, I love to write still, which is an odd right brain, left brain thing that's going on with me. But that also goes back to my experience with Bernie. When you write about things daily, first of all, it makes me better as a researcher, because now I'm involving on this screen, the data and looking at ones and zeros and something that's very technical. And on this screen, trying to write something which the rule I always followed is something my mom could read and understand. She could ask me questions and I could give her little bits of information, but never blow somebody away. And it's funny, the number one tool that I use to help me do that is one of those tools in Word, the Flesch-Kincaid score. When you just hit the old F7, the readability score, I make sure that I'm down at a 7th grade level, or, if I get a really technical, maybe I'm up at an 8th grade, but I learned that years ago, man. When it's at a 12th or 13th grade level, you've got to go back and start shortening sentences and making it so it's broken up into bits. That's how I, ironically, I've used a number to make writing about numbers relatable with that Flesch-Kincaid score. I also did a lot of writing back in the 2000s, early 2000s, a lot of writing for, chapters of books for Bloomberg, a lot of writing for, I'd guest write for Barron's every once in a while in the striking price. So that having an editor that's sending it back saying, just write this again. Eventually you get to that point where you're just having the conversation in the back of your head and saying, well, nobody's going to understand what my engineering head is saying. So let's go over here and, write it as if it's going to my mom. It's hard to do, I think, but once you get, I could probably never write as eloquently as you. And I love reading somebody who can write this, this way where you're expanding your mind. But I feel like I've gotten to that point now where somebody can read it and it is a couple of tables of data that will go with it, a few charts. And I always write so that you can look at either of those and understand exactly where my mind is going. So, Flesch-Kincaid score and keep it simple. That's how I do it.
I have the Flesch-Kincaid bookmarked on my Chrome. I use it all the time. Actually, I don't use it as much as I used to because I kind of have a sense of whether I need to use it or not. Like if I write something that's off the top of my head and I know the topic well, I know that my sentences are within 7 to 11 words and that there's not too many multisyllabic words in there. That's one of the big ones. And then jargon too. You got to get rid of all the jargon.
Oh,
and if you use a number, you got to explain what it is.
Absolutely. Have you ever had this feeling where you want to hit the button and see what the score is, but you're afraid to, and automatically
Yeah.
"Oh, this is not going to be good. I'm going to have to go back."
Yeah, that happens for me when I write about something that I'm like not clear in my mind about what I'm trying to say.
Yep.
I make up words. My syntax goes to hell, and I can tell right away if it's especially if it's a topic that I don't really understand. Like if I were going to write about derivatives, I would have to do a lot of research about, like, the way I would approach it would be, how many derivatives are out there. It's like outstanding $13 trillion worth or something. Like I would look at it from a macro standpoint, and I would be able to write about it from that perspective.
Right.
But if I were going to explain a short position in NVIDIA, since we're going to talk about AI in a minute, if I were going to try to explain that, I would frankly be lost. It would take me a while, and that's when I would hit the FK score.
That's right. It's funny when I first wrote about the VIX in a Barron's article.
The VIX is another one.
What's that?
I said the VIX is another one because it's hard to explain volatility to people.
Right, and
because it's a measure of the way the markets, the compilation of market activity.
Yep. And I remember my first article I wrote for Barron's, it was for the striking price. It was filling in for Stephen Sears. I think it was 1999. I still have the article in a file in the old closet here. And it must have taken 8 or 9 different iterations for it to make it through the editor. Because I started with, well, this is how the VIX is calculated, and this is what each one of these options meant. And by the time I had boiled it down to something that was acceptable, it's the market's fear gauge. It tells you how much people are paying for protection, and that's it. And my mind was like, no, they need to know exactly why, and it's these 8 different options and blah, blah, blah. And the person said, no, do it in about 12 or 14 words, and we're going to write about something else. Okay. So that's always a fun one.
When we train writers that are writing about stock analysis or the markets or economics, there's a lot of numbers that they have to go through. We try to convince them to write between 7 and 11 words per sentence. And that is a shocking number for people, because most people they think that you're trying to be smart. You write 30 words per sentence. And I try to adhere to it myself, but I'm not as disciplined as I probably should be. But
yeah, I once had an editor that, first of all, ironically, and it was a business partner afterwards, he would edit with I forget the brand of pen, but you could see the fins through it. And it was red. It was harsh. I think he had one pen that he used for my editing. And this is when he would edit on paper, printed paper. And I killed the pen. And my biggest sin when I'm writing, Addison, is either run-on sentences or a paragraph that will be, 12 sentences worth of paragraph. So I'm that guy that I put my head down and write. And sometimes it just came down to inserting, breaks there. But 7 to 11 is, wow. That's like me trying to run a 6-minute mile right now. That would be a challenge.
Well, it is a training exercise, so it doesn't always work. I wanted to move on to, it's a related topic, but you had mentioned when we were talking earlier, sentimental analysis, sentiment analysis. Yes. So how does that relate to the quant in you? Sentiment is a hard thing to quantify.
It is. The easiest or the most common, a lot of people will they'll fall into the trap of price movement equals sentiment. So if the price of a stock goes down for 20 days in a row, they think that sentiment is pessimistic or fearful towards that stock, or the reverse is true as well. If a stock goes up for 20 days in a row, the sentiment towards the stock, investor sentiment towards the stock is optimistic. And the first step in using and quantifying is understanding that it's not the easiest thing. It's not price movement. Those two are independent of each other. I can go through periods of time and show you stocks that the market hated, absolutely hated, and they continue to climb. Those are the best case scenario. Those are the ones I am always looking for. And then I can find you examples where a stock has continued to go lower, and the optimism towards it is off the charts. I can't not give you one example that I think you'll be familiar with. Cisco, back after the dot-com bubble, Cisco traded at $50, $60 a share. And I'll never forget, again, I was luck preferring the prepared person. I happened to have puts on Cisco. They came out with earnings. It was the first quarter John Chambers had announced an earnings miss. They always remember their trademark almost was beating by a penny. They missed by a penny. And the stock went from $55, $60 down into the high 40s. And immediately the response from the media, from everybody that you talk to was, well, Cisco's a great buy at 50. And it progressed lower over the next couple months and teased the $40 level, so another 20% lower. And everybody was banging the table saying Cisco is an amazing deal at 40. And then it cracked through 40. And the message got louder. Every time it would crack these psychologically important levels of zeros after them, 10, 20, 30, 40. Every time the volume would get higher on the bulls on Cisco saying this is the best opportunity you've had to buy it. So in that case, price was going down quickly and everybody was getting more bullish on a stock that fundamentally was in question at that point. The technicals for it were in terrible shape, but everybody was trying to catch the falling knife and feeling really good about putting their hand out there and grabbing it. That's a great example of when price or how price is not a good representation of sentiment. What are things as simple as magazine covers. Barron's is notorious for having, come out and opined on a stock saying this is a great buy. Actually, ironically, they just recently did it right before earnings. Disney was trading at $98 a share. They were going above 100. I think the week before their earnings, Barron's had a cover page, a golden Mickey Mouse saying why this is the best time to be buying Disney. We think it's a great time. What I always remind myself is that the writers at Barron's, and I guest wrote there for a couple times, and I know some of them, they're not analysts. They're there to report what's happened in the market. They're not there to really suggest or opine on where the market's going to go. And when they do it to the level of the flash of having a cover story on it, it's usually wrong. That's a great, simple measure of sentiment. When we read something in Barron's or U.S. News and World Report or any type of news outlet that is pounding the table on something, that's a good time to kind of step back and say, does it warrant the look that they're giving it to say that Disney's going to go from here up to 110? When in fact, when you look at Disney, when it breaks through $98, that's going back 13, 14 years to the last time that it was playing around that price, and it was on the way up at that point. That price trap, again, of acting like sentiment equals price, got them. The stock just tumbled, last week by, I think, 8%, and is trading, towards an 80. And probably, I'll be interested to see if they say 80 is a perfect price, because that means 70. So magazine covers is one. I don't want to get too far off from your question. Magazine covers is one very simple way to read the market sentiment. When you start quantifying it, you start looking at the options activity for underlying stocks, finding out how balanced the demand or the purchasing of options on a stock is. And it's as simple as saying sometimes, hey, if you're seeing 3 or 4 times the amount of calls being purchased on a stock, that's the market saying we're pricing this thing for perfection, which is, from a sentiment perspective, that phrase that you want to be able to utter about a stock that you're calling a top on. This thing is priced for perfection. The expectations are through the roof. investors' behavior is showing you. I always say, Addison, it's one thing if I walk down the street and ask 100 people whether they're bullish or bearish on NVIDIA, and 98% of them come back and say, I'm bullish. That's one thing. If I walk down and ask the same 100 people, are you bullish or bearish enough to buy a share of NVIDIA? So, the old take a couple bucks out and put them on the table, put your money where your mouth is. It's a completely different read of sentiment. People will say anything, but when they back it up with a trade or an investment, that's when you can start to not only quantify it, because now I can read into what's going on with that universe of stocks, but I can now say there are people that have backed up what they are saying, their expectation for the stock. So options activity is one way to quantify it. Short interest is another. Although it's lost its effectiveness over the last year because of the GameStop situations and all of that. Everybody's kind of chasing the same short squeezes now, and that goes back to something I said earlier. The groupthink normally doesn't work on Wall Street. So, but short interest is a great way, and I just look for stocks that are performing extremely well, that have high amounts of shorts on them, because it tells me there's a large crowd of people out there doubting the current trend. And if it continues, short interest is unique in that you will get a short squeeze at some point, and it'll drive those prices higher. So those are just a couple of the things that I'll look at to start to quantify that sentiment.
It's interesting that you used Cisco as an example, because I just put to bed this morning the final edits on third edition of Financial Reckoning Day. Uh-huh. And in the opening, we started writing the first edition of that book while Cisco was at $60 or whatever. Uh-huh. And our analysis was more of a fundamental look. They had gained a lot of interest in Wall Street because they were acquiring a bunch of new businesses. So their balance sheet was packed with the debt of other businesses, but it was going up because it looked like their business was expanding. But what they were doing was they were using shareholder value to buy new businesses. So when you look at sentiment, you were using it as an example of sentiment is going down, but people were still bullish on it. Do you ever connect the dots to the fundamental analysis? Always know. I mean, that's one of those rules. If I put it in order of importance in terms of the three things that I follow, and those would be technicals, the sentiment, and the fundamentals. The fundamentals will be that last little check of, does this make sense? Does it pass the Snicker test? You can have a company that's been trading higher that, sentiment is pessimistic on, that tells me, you know what, this is something I should be perhaps looking at as a purchase. You always have to have that gut check. I can't think of an analogy. It's like checking the fuel gauge before you get in the car and, going on a long trip. That one thing that I have to do before I really say what I'm going into this for a longer haul investment, not just a trade, because I can get to a trade with the technical and sentiment on its own. But if I'm buying a stock for the longer run, the fundamentals have to then line up with it to say, yeah, this is a good company, fundamentally solid, that technically is doing its job. And from a sentiment perspective, nobody's giving it any respect. At some point, they're all going to jump on this stock and they're going to start buying the heck out of it. NVIDIA is one of those examples. 2007, 2008, back when they were just doing chips for the screens on our computers and they were getting into the automotive industry, it was the most hated stock in its sector based on Wall Street analysts' recommendations, or buy, hold, sell, which is another way to quantify this. Target prices for NVIDIA were well below the current price for NVIDIA back then. That stock left the rest of the market behind. And that's back, 8-9 years ago, simply because Wall Street finally caught up and said, oh, the fundamentals are good. The company is performing well. We should have buy recommendations. And then there's a self-fulfilling thing where, again, that group think if you're
independent of the group and standing out here doing your own thing, eventually they're going to catch up and catch up with you. Do you want a 90-second analogy that explains the group thing?
90-second analogy, but I want to ask more about NVIDIA because I think it's a really interesting example of what's happening in the market this year.
Okay, let's do the group think here real quick. My oldest son was 3 years old. I started coaching his hockey team. He started playing at 3. At 4, you start throwing kids out on the ice. There are 10 players, right? Plus your 2 goalies. Back then at 4 years old, when I would put the puck out on the ice, all 10 kids, there was no such thing as positioning. Everybody went after the puck. And if the puck went into the wall, everybody went into the wall and everybody fell. It's not until the players at that point get away from that group think of just chasing the puck. In this case, it would be stocks, and start to think, okay, I'm going to play independently and get a position where the game becomes an actual game. And you begin to score because you're thinking independently. You're not getting caught up in that group that's in the wall. And whenever I tell that, I always talk about the old Wayne Gretzky quote. He never skated to where the puck was. He skated to where the puck was going to be. That's what using sentiment and technical and fundamentals allow you to do, kind of separate from the group and skate, to where the stock is going to be. And back in the case of NVIDIA, everybody hated it. It's best stock to own at that point.
What do you think of it now? And I just want to give a little background just because I've been watching NVIDIA. It became a $1 trillion market cap company this year. They reported above expectation earnings 3 quarters in a row. And each time they jumped by, this is the second quarter, I think they jumped 249% or something like that. And then this most recent one, they jumped about 25%. And most analysts were saying, well, the bubble in AI is over. NVIDIA is showing us that there's not a lot of room there. But at the same time, it's a good company that's making money.
Yeah. First of all, NVIDIA is one of the greatest pivot stocks that I've seen. Amazon.com is one of the best pivot stocks ever. Microsoft is up there. Apple is up there. And what I mean by a pivot stock is they are able to adapt with the market. When they have technology that has run its course, they're able to use that and pivot to another part of the market. NVIDIA went from video cards to automobiles to Bitcoin mining and now to AI. So 2 things that you just said. First of all, it always worries me when people say that a bubble, the idea of a bubble is not there. It reminds me of the old irrational exuberance in Alan Greenspan. He was eventually right. But there's that thought. Again, the groupthink is that it's all clear. You can go into the pool. NVIDIA, as well as other AI companies, they're in this weird spot. What we've experienced with AI is true innovation in the market. It's rare to find true innovation like this that is going to change the market, the way that we do things on a daily basis. We've been dealing with AI for the last 9 years. When you call up and you complain about a robo operator, that was AI 10 years ago or 9 years ago. It's been part of our life. It's now reached that point where the market has become aware of AI. The first reaction from a market, in NVIDIA's case, 240%, 22%, you have these moves in the stock that are unbelievable. That's because the market doesn't know how to value AI yet. It hasn't figured out, you could put a value on one license of Microsoft Office, right? That means X in revenue for Microsoft. And the market knows that. And when Microsoft comes on their conference call and says Office subscriptions are up by this, you can bottom line it to a number and figure out whether the company is making money off that well. We don't have that number to quantify the value of AI yet. It's this nebulous thing that continues to grow. And as a result, that market awareness is now gotten to the point where, as you mentioned, you've got another $1 trillion company, which is an amazing club to be a part of. But it also leaves this void or this thing of when people say there's no bubble, That's kind of that warning that I'm looking for, because it's just plow everything into it. The first time NVIDIA's revenue week and a half ago came in at 101% higher than last year. 2 quarters ago, it was negative. So it's become a juggernaut because that revenue, and it's real, feels like it's unstoppable. And they're bringing on, the thing with them is they're bringing on many new clients here, which is the key. So this is just not existing clients increasing their orders. It is new people coming into the fold. I see it from a perspective of, this is kind of like what we saw when yesterday when you and I kind of talked a little bit here, the tulip mania, where the market goes from being aware to all of a sudden something causes it to trip up. In this case, it's when we start to put that number on what AI is worth, which I think we'll see in the next 6 months or so. We'll start to get a hint of what it's worth. And you also get the false players that come in and start to, in the 1999 period, it was everybody putting .com after their name, pencils.com and pens.com and that type of thing, that frenzy. NVIDIA is truly, though, I think, in a sweet spot with AI. And as I said, as a company, because once the AI, believe it or not, and it does feel like it, there's something coming on the other side of AI, right? I mean, there has to be. That's what keeps us going, innovation. When we value, what's that?
I'm just wondering how going all the way back to the tulip mania, and then in Financial Reckoning Day, we cover the Mississippi scheme, which was John Law in France, like 10 years after the bubble in the Netherlands.
Mm-hmm.
They repeat themselves periodically throughout history, and each time there's this problem with valuation. Like, how do you value a tulip because it has variegated stems or something? Like, right. it becomes completely irrational, and it becomes a popular delusion. And we cover those ad nauseum in the stuff I write about, but we did talk about it yesterday too. I think you have a poster above your screen of the tulip mania, right?
I'm looking at it right now. The tulip price index chart, and 1633 or so is when you started. Yeah. That bubble blew up 4 years later in 1637, and you just nailed it. It is a pattern. It happened with the financial crisis in 2007. It is a pattern. I mean, you
mentioned the .com. That was the beginning. I mean, in my career, the first one was the .com, and there was such a frenzy that I was like trying to learn how to comprehend the markets and like what I should do with my own money and like all this, and nothing that I was seeing either in the headline news or in analysis or things that people were writing, none of it made any sense to me. That's why we started started the project in the daily reckonings, because we were like, wait a minute, none of this makes sense. And then we went through that period to the 2007 2008 bust of mortgage-backed securities, which were in their own right. They were an innovation in the market too. They should have worked, but people went crazy with them, and they bundled bad debt with good debt, and then the rest is history there. Yep. We just saw that in cryptocurrency, and now we're seeing it in AI. And that's always the challenge for macro thinkers, is like, after AI, like you mentioned, what's next? What is going to be the next thing? But in the meantime, we have to go through dislocation in the market, because AI is going to cause all kinds of imaginations to flare, and we don't know what's going to happen with price value.
Yeah, it's interesting to always watch, and you only get a view of it 4 times a year. But now, the number of companies that use the phrase or the term AI in their quarterly reports. A year ago,
through the roof, right?
What's that?
It went through the roof.
Yeah, it was like 50 some companies in 2022, and this is of the S&P 500. So, call it 10%. And now you're at like 240 some. So they're going to be, and this is the thing I always warn people, we're going to have a bubble, and it's going to be a huge opportunity too. If you look at what happened with the bubble in the .com, that's the closest thing that you're going to be able to relate to in current history. And everybody thinks, oh my gosh, that was a miserable time. And it was. I mean, I traded my way through that. But the companies that were truly the innovators there, the Amazon.com, the Microsofts, the Intels, the Yahoo, you could say for a while, but they fell astray. I mean, that was an opportunity to grab these companies that now are up thousands of percent in some cases. You could have bought Amazon for under $1, but it was after it had fallen 93% or 94% from its highs heading into the .com. And nobody wanted to do that. They just wanted to throw the baby out with the bathwater. That's going to be the next, in my opinion, huge opportunity in AI, is to be able to go out and buy NVIDIA for 50% of what it's trading at right now, maybe even 60% lower than what it's trading at right now. It's going to happen. At that point, I think it will be different, Addison, because investors, and we skimmed on this yesterday, investors have turned into traders for all of the
unwitting.
Yes,
unwitting.
Yeah. And the pandemic helped to kind of seal that deal. We hear about the free money that everybody got and how they started trading it on their Robinhood accounts, and it turned into a video game. Ironically, I was seeing somebody that would literally sit there and buy biotech stocks on a Robinhood account, and it was like a video game. So we have really, that clinched it. My mom knows what's going on in the market at 81 years old. She's actively watching the market. She's supposed to be watching what, CD rates are doing and things like that. So I believe in my heart that when we do have an AI bubble, and it's coming, it's not going to be as extended. It may be as deep, but it's not going to be as long as what we saw in 2000, 2001 with the .com bubble, because people are now trained to start buying the dips. In the last 5 years, NVIDIA's dropped 50% twice. It actually has. Nobody would really think that could be possible, but it has. And both times were great times to buy. I mean, they were incredible times to buy, obviously, with it at new highs. But you're going to see some of that behavior here over the next, again, in my opinion, 6 months or so, where everybody's going to fall out of favor very quickly with AI and feel like maybe it's a scam. And it's not. This is just part of the tulip mania chart that I'm looking at. We're going to have, right after that awareness phase, everybody got too excited. It's going to pull down. And that's when the real mania is going to kick off, and you're going to see these AI stocks tear through the roof. It's also where you're going to have false actors that are going to go down to nothing.
The way I have looked at it is that, especially having lived through the tech wreck, .com bubble, the innovations that have powered that stick with society, I guess. They become useful tools. And I've been making, we ended up with email and websites and eventually things like Zoom, like we're talking about now, because of the tech bubble. Mm-hmm. The activity of the stocks on Wall Street is divorced from that entirely, but the underlying innovations persist. And I think the same is true of crypto. I think blockchain is going to be with us for a long time, and it's going to make things like banking, at least interbank banking, much more efficient. It's going to be efficient, and it's going to reduce costs over time, and that's what's going to persist. Whether cryptocurrencies as a payment exchange system actually exist 10 years from now or not, that's debatable to me too. But in the meantime, you have this wild market gyrations in Bitcoin and Ethereum and things like that. But blockchain's here to stay. I think AI is going to be another one of those things. It's like it's going to be a very useful tool for people like me. I use Bard and Chat GPT all the time, not necessarily to cut and paste, but it does a lot of work for me in a very short amount of time, and helps spur my own thought processes on writing and whatnot. And then I know where, if I want to dig in deeper, I know where to go. That used to take multiple searches on Google, and even Google itself was an innovation that has stuck with us too. We can search the internet, find information instead of going. I remember in the early days of my own writing career, I would have to go to the library and use microfiche to find stuff. So, I think all of these things are great things, but it's really important for people to understand that the market value of these companies is completely divorced from the value of the technology itself. So I have two questions. One, NVIDIA, I'm still stuck on NVIDIA here. They're kind of, since they make chips, aren't they just like the picks and shovels of the gold rush, or the J.C. Penney that made indigo jeans available for everyone?
Yes. Yeah, I'm calling them the foundation of AI. I mean, they are at the source of it. They are Intel in the early 1990s, as it led into the dot-com bubble. You needed to have a backbone for the internet, and semiconductors, ironically, were the thing that did it back then. Motorola was one of the big players back then. Intel was the big player, and is still trying to get in on the AI game. But yeah, NVIDIA is going to be part of the backbone of this for the foreseeable future. Somebody's going to come up. AMD is going to challenge. There are going to be other people that will, and that was the case with Intel. Everybody tried to copy, but that takes so much time because of the IP that's involved. And, this is something that's been years in the making, not quarters. So they're going to be it. They're the center of this innovation.
What do you make of AI in general? There's a lot of talk on the internet, especially on programs like mine, where people are afraid that AI is going to displace a lot of workers. That we hear that going all the way back to the Industrial Revolution in England. Anytime there's a new machine or something, that the workers are the ones that are going to pay the price. And also that there's a lot of people that are worried that, I was reading this in Bloomberg of all places, that there's a Venn diagram between AI, nuclear power, and nuclear weapons. And right in the middle is the place where AI could get control of that whole system. Like, there's a lot of fear, which also comes with innovation too. So what do you think just in general of AI as a tool in the markets, or as a tool for just efficiencies in manufacturing and that kind of thing?
Scares the hell out of me. Next question. It truly does. And this is where you get into somebody's philosophical beliefs and all of that. But I think we, as, call it a human race, whatever, we tend to swing that pendulum of innovation as quickly as possible to favor us, instead of measured approaches. And it's funny. When did Henry Ford start mass producing the automobile? 20s?
Yeah, early 1900s. Yeah, it was earlier than that. Yeah, 1908, I think.
Yeah, 1908. That is, yes. We didn't get into heavily regulating, automobiles really until like the 50s and 60s. It's ironic. I still think about the vehicles I remember riding in, my parents' Impala or their Cutlass Supreme, where safety measures were lacking. We had the old safari wagon at one point. You'd have 6 or 8 kids in the about this time, well, a little earlier. We've got a place in Maine. We'd have 6 or 8 kids rummaging around in the back seat while my mom's driving 70 on a oil and gravel road, or oil and sand road. It wasn't until, call it the last 3 or 4 decades, where we started actually regulating that and, having a lot of control over quality and all of that. So if you take that, and that being a huge innovation that changed society, we're going to move much faster with AI, but there's going to be some things that have to be done to make certain that we don't run wild with it, and call it a little bit of lack in the human race that I don't know that we have that kind of restraint right now. We're an immediate gratification society, and this innovation can provide a lot of gratification, but I think it also comes with expenses that we're probably not going to take into account until we have a whiplash effect. For that reason, I feel a little, we need to be a little more cautious about AI instead of jumping in with both feet. You're going to see governments start to regulate, which we know how well that typically works. And I think that's going to be necessary to avoid situations like to avoid crossovers into potentially disastrous situations, whether it's, with nuclear codes or
Power plants.
Power grids. I mean, I'm sitting here thinking about, they always talk about how the science fiction writers nail everything 20 years, 30 years before. Well, I don't know how old Terminator is, but my gosh, that's the first one that comes to mind. And anytime I see one of these Boston Scientific robots, doing a flip and getting smashed with a sledgehammer and still getting up, I think to myself, my gosh, I don't want AI at that level. So to bring it a little more centered and off of my mind wandering, from a production perspective, look at what we've gone through the last 2 years with employment and not having people to come in or coming in to take jobs that they didn't want, whether it's flipping burgers at a McDonald's or picking a crop in California. I think AI is going to be productive in those areas, and it will be helpful for us. I also think we're going to have that double-edged sword of, at some point, people are going to want those jobs again, or they're going to need them, and they're going to be filled by AI. And the idea that you're going to go out and, well, just go out. Historically, we've always been under that assumption that, well, that's okay, because now you can just go and learn a new trade, or you can go and do this and that. AI is already going to be learning this stuff. So, boy, I'm giving you a really good outlook on AI, aren't I?
Yeah. Well, I'm just curious because we don't know what the outcome of AI or the impact of it is going to be. So
Right.
it's only like achieving sort of market consciousness right now, as you pointed out before. How do you regulate something that you don't even know what the impact is going to be? Like this is where government gets in the way all the time.
Right.
They respond to the fear factor, and then they regulate in places that they're not productive. And they do it all the time. They do it in every industry. But how are we going to regulate AI if we don't even know what it's possible or capable of doing? Like we don't even understand it yet.
No, this will be
There's a lot of people that are afraid.
Yeah. Oh, there are people that are afraid. This will be a hindsight 2020 thing for regulators. If you look at the .com bubble, the first thing that always comes to mind with the .com or the internet. Let's take internet and AI and put those two together and say you're going to have the same type of jump up in productivity and all of these things, but the cost is going to be at some point loss of security. We look at the internet now, and everything that came about in terms of innovation in the early 2000s has now also resulted in us worrying about identity theft and, elections being run, from some nefarious server in Russia, or these things that are real concerns. We're just now catching, and the internet's been around more than 20 years in terms of, 30 years in terms of our use. So it's going to be long and drawn out, and we're going to have a lot of risk at an individual level, at a societal level, all of this before they think the regulators get effective. And that's the key word, effective at regulating.
Well, it's going to be interesting. I mean, it was the years following the tech wreck were pretty interesting too. The Fed response was to drop rates to nothing, and then speculators jumped into the housing market. If AI is what we think it is and it turns into a bubble, the Fed response to a collapse will probably be similar. We'll get rates down low again, and then people will be searching the next
Yeah,
searching for next innovation, next bubble.
yeah, it's funny you bring up the Fed because that is one of those things that everybody's kind of responded to and said they didn't know what they were doing. They didn't know what they were doing. Why are they continuing to raise rates? You know, those of us that remember rates that were at this level and higher go, well, gosh, there's a natural resting place for interest rates. And we
Yeah.
have not
Well,
been.
we're talking about 2000. The tech wreck was in 2000 or began in 2000.
Yep.
That's when rates were at this height.
Yeah. And you had a period all the way to 2005 where they came down and then they started coming back up again. And we had Ben Bernanke that was in charge of the Fed at that point, and everybody had the same complaints about Ben Bernanke. He doesn't know what the hell he's doing. Da, da, da. This isn't an easy thing to navigate through, first of all. Second of all, as somebody who's seen how the Fed reacts to, something like the dot-com bubble, it is that natural reaction to lower rates and try to, get the economy going again. There was no room for the Fed to do that 2 years ago when we're bouncing across zero in terms of interest rates. So if anything, the Fed has done over the last year a good job, and they should thank inflation for being the excuse they could do that, to get rates up to the point where they have bullets in the gun when we do run into a recession. Because Germany, there have been a couple different countries that have tried the old below zero interest rates to stimulate, and we see how long that takes to dig yourself out, and your debt to GDP goes through the roof. Japan being the one that obviously sticks out there. Our GDP is 120%. Our debt to GDP is 120% right now, and I think you've still got Japan. They're still over it.
Japan went to 240 recently.
Yeah, I think they're probably still around 200 right now and just starting to dig their way out. But that's also not that I'm not trying to sideline us to another, a central bank discussion. But if you look at the G7, the central banks there, debt to GDP, I almost said equity, but it's the equivalent, is probably averaging 80 to 90%, probably 100%. So we're following the course that's out there. And guess what? China's getting ready to go down that central bank road as well. You're going to find China, who's at a reported, I think, 18 or 20% debt to GDP. My gosh, they could make us look like fiscally responsible regulators or government if they have to really roll out the stimulus. That's one of those we talk about my fundamental views and how I don't normally use too much in the way of fundamentals. I start looking at the fundamentals when I start thinking about China and, what's happening with India, and who's the next China is a big question. Who's the next China that's going to be our partner in manufacturing and all of that? Because China is now running into those same problem. Welcome to the central bank club, I guess, right?
Right. Well, India is probably the best candidate for that, or maybe Indonesia if they could get their act together.
Yeah, I think.
Chris, I want to thank you. We've covered a lot of ground.
Yeah,
and I'm interested. I want to talk to you again because I'm interested in applying sort of the micro approach that you take, the quant approach, to a lot of the stuff that I write about on a regular basis.
Yeah,
I think we should continue to talk and just see where it goes. I'll tap you again when we see some kind of disruption in the AI AI bubble.
Let's agree on that. Yes, absolutely, Addison. It's been fun.
All right, great. Thanks, Chris.
Thank you very much.